My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate, teach, and coach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. An employment number that's strong, but not too strong, was just what this crazy market needed today. Although it took half the day for Wall Street to figure that out. Dow going down at first, but then eventually finishing up 572 points. S&P gaining 1.95%. NASDAQ advancing 1.55%. It was a hidden Goldilocks report, let's call it that. A lot more people are getting hired thanks to the vaccine rollout in the opening. But not so many that the Fed will feel compelled to raise interest rates, and some are really being left behind. Why does that matter? Because the bond market is calling the tune right now, and when the bond market's pleased, meaning Treasury yields are stable, as they ended up today, or even go lower, didn't get that, buyers rush into the stock market because they know the competition from bonds will remain benign. A benign bond market serves as an all-clear signal for the stock market bulls. Now, this has been a confusing time for fixed-income investors because the whole narrative on the economy changed practically overnight. We went from a period of stagnation, where we were propped up by government spending, to the beginning of what could be a potential boom as more people get vaccinated and Washington gets ready to throw more fuel on the fire. If the economy is poised to get so much better, why the heck do we need the Federal Reserve to keep giving us easy money, right? Interesting question. And that is the bond, what we call the bond vigilantes position. They want rate hikes. They think the economy's too hot. I get that. However, Fed Chief Jay Powell insists that he won't tighten anytime soon because so many people are being left out of potential comeback. The inflation is really just nascent and could go back down. And even though he's been very right on the economy so far, the bond vigilantes have decided he's just some dove in a suit who's going to create a tsunami of inflation with his stance. I think they're wrong. I think Jay Powell's right, but I'm not the one who controls the bond market. I keep telling you this moment feels like the period from November 2015 to February 2016, when our old Fed chief, Janet Yellen, looked at the dashboard of the economy, very similar to right now, saw some inflation indicators flashing red like we have right now, and decided it was time to raise rates, even though she appeased the bond vigilantes and gave us ample warning. The economy was crushed and stocks took a hit. And that's what I fear. I fear a repeat of that time. And I am staying not as a vigilante, but I'm staying vigilant. Powell refuses to be cowed, but the bond bullies, who are very powerful, don't believe it. The Fed's had a zero-tolerance policy toward inflation for my whole career. These guys can't imagine suddenly there's this guy Powell who would chart a new course no matter how many times he explains it. Now, the session opened rocky because lots of investors bought stocks with borrowed money over the last few weeks. Margins nearing a record high here. And they got blown out by this week's decline and a sharp initial move up in rates in reaction to that employment number. But then rates reversed, and we got one of those whoosh bottoms I've been telling you about, where we have a sharp decline fueled by forced selling, and then the market swiftly rebounds when that selling is over, if the bonds rally and interest rates fall. And that's what happened. So are we out of the woods? No, that's just one day's worth of a scenario. Not so fast. The battle is far from over, with lots more collateral damage, particularly, by the way, I don't know if you noticed, but the highest growth stocks, even today, and the myriad SPACs, they're still being taken out and shot despite the nice backdrop. Basically, everything was red hot a month or two ago is not so great. So here's how I see it playing out. Whenever we get good news for the economy, like when the Senate passes a stimulus package, or when we get big vaccine benchmarks, the bond vigilantes will come out of the woodwork with the same playbook that you saw earlier this week. They will dump bonds, pushing long-term interest rates higher and triggering more weakness in the stock market like we saw yesterday. The only thing that will stop the bond bullies is weaker economic data, especially lower commodity prices like oil, copper, lumber, plastic, and paper. That hasn't happened yet. But if you got those lower, then the heat's off Powell. But we're not there yet. So expect more of what's happened in the last 2 days. With the bond stock prism in mind, as cloudy as it is, what's the game plan for next week? It's not as important. All these are not as important as interest rates going higher. But you need to know how companies will do in order to be able to figure out which ones you want to buy. Now, you've heard about the highly successful short-busting campaign in GameStop. But did you know that one of the original short busts was Stitch Fix, the online fashion advisory service? The misguided shorts tried to crush this thing until CEO Katrina Lake turned the tables on them. And that was 3 months ago. She delivered a spectacular quarter. She got a great business. You got a huge rally on the backs of the short sellers who had to buy the stock to close out their broken positions. But now almost all the shorts are done. So what happens when Stitch Fix reports still one more good quarter Monday night? Well, even a great quarter won't produce the kind of explosive reaction we had last time. Still, I'm betting the numbers are better than expected because, well, this is a great business. Tuesday morning, we hear from Dick's Sporting Goods, and I like the way these non-essential retailers have been trading lately. Seems like there's been a bit of a jailbreak of shoppers headed to the stores. I expect Dick's to deliver a very strong number, one that could send the stock flying. The company has a new CEO, Lauren Hobart. She was on last time the show. I think she'll wow the conference call audience with a good tale of strong sales going into an economy that's about to open up to all sorts of sporting events that have been on hold thanks to the pandemic. Wednesday morning, little contra. Campbell's Soup, they report, I like the management here, but so far these pantry stocks, they've failed to impress. I can't go against the prevailing wisdom here, although I think the company's won over enough of the stay-at-homers with its snack offerings that you won't be that disappointed, and you get the 3.2% yield. But let's just say in the old days, I would say, not working. After the close, we get the results from Oracle. Now, this is exactly the kind of lower-risk tech stock that people suddenly like. They don't like the dreamer stocks. They don't like the high flyers. Those are still getting torn to pieces. So I was ready to recommend Oracle when I was putting my game plan together, but I got beaten to the punch. A big brokerage house pushed it today, sent the stock up 6%, stole my thunder. But think about that. And on an upgrade, 6%, because it's a lower-risk tech. They don't like high-risk tech. Thursday, we hear from two winners. There's JD.com. That's one of the few Chinese stocks I like because it's another Amazon on China thing. It's like Alibaba, which, I like. It's got faster growth, though. And then Ulta Beauty, Cramer fave cosmetics retailer. It's about to experience a sales explosion when the country reopens. Ulta pivoted to e-commerce when the pandemic hit. They've got a great app. I use it. But now that we're getting vaccinated, the brick-and-mortar businesses can make a comeback. Plus, they're rolling out a new Target collection. I'd be a buyer ahead of that quarter. And then finally, on Friday, we got something for those of you who are on fixed income. I'm talking about ATT with that 7% yield. Enticing? They're holding an analyst meeting Friday, and I bet you'll want to hear how the company can afford to maintain the dividend. But you know what? I wouldn't be a buyer. I think it's never worth the risk to reach for yield in a suboptimal situation. Because if something goes wrong, the losses in your principal, this common stock, outweigh the dividend payments. So why don't we just sit back and listen and see how they're going to solve that balance sheet. So next week's going to be a lighter one, all right? But we're looking for any signs of commodities abating. Remember, we want this. If oil goes down, the pressure is off, pal. And then interest rates are going to come back down. And then the bond vigilantes will be off our backs and stocks can rally. But on the other hand, if oil prices keep rising and we get more retailers complaining about costs like we heard from Costco, then get ready for rates to go higher in the stock market. It's going to repeat what happened yesterday, not today. The bottom line, I'm betting the bond bullies will be back. So get ready by using rallies like this one to lighten up, as we did for my charitable trust at the end of the day. And certainly lighten up on the high-flying dreamer stocks and the SPACs. That way you have some cash to deploy for the real companies the next time we get hammered like we did yesterday afternoon. John in Louisiana. John!
Jim, as a member of Action Alert Plus, I'm calling about the highly rated cybersecurity company with 90% direct-to-consumer sales. Given the current rotation into value, combined with workers returning to the office, I'm wondering how much longer we can continue to hold on to NortonLifeLock.
Well, when I was on our conference call yesterday for ActionAlertsPlus.com, that's my charitable trust. You sign up to the club, you get to hear it. I'm getting discouraged. Because this thing doesn't seem to want to go higher. But you know what? Every time you get discouraged, you got to stay the course for another quarter if you believe the business is good. And I still believe the business is good. And look, I parted with Waste Management, and then that thing just went up. And, look, no say, woulda, shoulda, coulda should not be part of the equation. But thank you for those nice words. Let's go to Brian in Wisconsin, please. Brian.
Jim, Booyah, home of Wisconsin, home of the Green Bay Booyah Northwoods League baseball team, and they also have the largest Booyah kettle at the stadium. You're going to have to try the Booyah there sometime.
Oh, man, I thought it was cheese. Little did I know. It was Booyah the whole time. It's a Booyah head. You got to put a Booyah head on it. Go ahead.
You bet. Let's talk Intel. Earlier this week, they lost the lawsuit, $2.18 billion judgment against them. On a patent lawsuit. What's that going to mean for Intel? And was today's rally just bargaining?
No. The rally's because this guy, Pat Gelsinger, is a real deal. He came from VMware. He used to be at Intel. He's very impressive, very smart. Known him for a long time, and people are believing that Intel is going to come roaring back because of him. There are a lot of cultural issues that he has to fix. I don't think it's going to be done overnight. But when you see the stock rally, it's because of a believer in Pat, not necessarily because they think the stock's going to have a quarter's going to be good. How about Kevin in Texas, please? Kevin.
Booyah, Jim from Sugarland. How are you?
Sugarland. Wow. Know it. Go ahead. What's up?
Oh, I've been seeing a lot of red. That's what's up. My portfolio's really down. But
I know.
I'm calling today because of AMD. This is my longest position I've held since May.
Okay.
This is when I first started buying.
All right.
I'm up in it, but I don't know what to do. Should I take out my cost? Should I buy more? Should I move it into something
all I can
different?
do is tell you what I did today for my charitable trust. We watched this thing go from 94, went down today to 74. We waited 20 points. We pulled the trigger, and we bought some for the charitable trust because I just don't think it's that big. Yes, I understand that Intel's got a new CEO, and that's part of the problem. I understand that there are chip shortages. That's part of the problem. I'm a believer in what Lisa Su's doing. I'm a believer in the diversification with Xilinx, and I think you have to buy AMD, not sell. I'm partial to it because, holy cow, has she made us a lot of money. I'm not giving up. Let's go to Scott in Florida. Scott.
Hi, Jim. I'd like your opinion on a beaten down stock. It's Regeneron, and thank you so much for everything you do for us investors.
I am confused by the stock of Regeneron. Why? Because Dr. Len Schleifer has done many great things. They've got a lot of terrific medicines, but I do know that ARK Investments, and I follow them, has been a seller of Regeneron, and that tends to weigh things down. And I also know that they're, while they have a cocktail that is very good therapeutic, they're not making, against COVID, it's not like they're making billions of dollars on it. But to give up on Regeneron here is just nutty. They're too smart and too good. And so is Dr. Yiannopoulos. I would not sell Regeneron at these levels. All right, look. What does Powell need? He needs a decline in commodity prices, particularly oil prices. And then he'll get the green light to maintain the Fed's easy money policies, and the stock market could have more days like today. But if these commodity prices head higher, be prepared for more days like yesterday. And use rallies like this one to reduce exposure to those high growth plays. They're easy enough to find. They were all down today despite the rally. On Mad Money tonight, after a wild week for the tech stocks, I'm talking to Cramer fave Okta. Fresh off our earnings, get a better look at the quarter. Boy, has that been hammered. Where does the company go from here? I've got the exclusive. Then, is Trex built to last? Home renovation surges, people stay at home, but now what's on deck? They don't act that well. And more cloud coverage ahead. Investors are eyeing the reopening trades. But what does that mean for the work-from-home winners? I'm talking to the CEO of another stock that's gotten beaten up, Nutanix, after his first earnings report as CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.